All right, so far I can see, yeah, a few people have arrived. Let me just do a sound check, see if anyone can hear the audio. And for that, I'll also have to look at the chat. Okay, so for people who are just joining in the meeting, if you can hear the audio and see the screen, can you just type a message into the chat to let me know? That's awesome, thanks, Ben. And Dave, can you see the chat at all? You might be able to see the chat if you click on the chat button in your Zoom.
Yeah. Yeah, I see it happening. Now I'd like to park it on a different screen if I could.
Yeah. Great. Hi, everybody. Awesome.
Hello,
thank you all.
Everyone.
Can everyone hear Dave as well? Great.
Well, it's certainly good to be heard by all. Someday I want to be seen by all. I don't know, you just can't wait to do that.
Yeah. Well, luckily you've got a new tripod for your camera, and so virtually people will be able to see you eventually. That'll be good.
Well, I'll tell you what, it was a really high priced one too. I spent $40 on that tripod. Big spender, huh?
Mm-hmm. Very good. I'll tell you what, we seem like we have quite a good crowd here. So why don't I just get started? Thanks everybody for joining us this Sunday. I'm going to say morning, but over here it's already dark and it's already evening. I'm in the UK. And I'm online with Dave McMullen, and Dave is in, I believe, Texas. And is that right, Dave?
Yes, north of Houston.
North of Houston. Okay, so morning for most people and evening for me. Now, the reason I wanted to start this webinar was because I had received some mail from Dave over the last couple of weeks that had given some nice pictures about some of the trades that he was making, and one particular trade with Tesla. And the pictures were, as I said in the invite to the meeting, a picture is worth 1,000 words. But even after looking at those pictures, I still wanted to find out more. And so we have been talking over the last couple of weekends about the trades. And Dave has some great techniques that he uses for finding his trades. And he uses EdgeRater for some of that work. And so we're lucky that Dave is here to actually talk us through some of the screens. And I'm very pleased that he's here, actually, because yesterday Dave wasn't feeling too well at all after a vaccine shot. And so very happy that he was able to make it here. Otherwise, you would have had to listen to me talk for a little while, which would not be so good. So here is, if anyone has not got EdgeRater and would like to take a trial, and you can see some of these screens, everything that is available in the full version is available in trial. So anyone can go to this website to download a free trial of the program. But anyway, I'm very excited to listen to what Dave has to say, and I would like to then pass the control over to Dave, and hopefully, Dave, you'll be able to share your screen without me giving you the host role. Let's see if that works.
Hello, everyone. My name is Dave McMullen, and I have fun trading. And one of the things that I don't do is I don't get stressed about trading. But I can tell you that wasn't always the case. I started with a very small account when I was young, and now I'm old. But I've acquired tools over the years, and many of them you may see down here below on my screen. And what I'm going to do is I'm going to drag one of my things. Oh, that's not the one I want. Let's go back here. This is the one I want. You see that? If you can see that, please type yes in the chat box. What this was a trade that I had done a few weeks back. Yeah, let me see. Let me do this. Does that help?
Yeah.
Okay. All right. This is actually taken off of another software package that I can actually do charting of options. And this one happened to be the August 19th expiration, 11:50 call on Tesla. And I think you have all seen these that I sent to Chris. Let's see what this one is. Yeah, this is Tesla. And this was a screenshot taken out of not Tasty Trade.
Looks like Think or Swim, Dave.
Think or Swim, that's right. I'll tell you what, yeah, on Thursday, I had a shingles vaccine because my wife currently has shingles and she insisted I go get it. And so, not shingles, but the shingles vaccine. And it has kicked my butt. And I can tell you, I was trying to remember the name of a lake that we used to go to, and I couldn't even remember that. I made her Google it this morning while she had a lucid moment. Anyway, this is a picture of Tesla, and I'm not sure I can make it bigger, but I will try. Nope, can't. Anyway, your entry for it would have been back in here. Okay, this is what is called a squeeze, and this is what George Lee was always looking for, was a squeeze, and we'll talk about that in Edge Raider in just a minute. But what I try to do is I try and use the squeeze, the moving average crossover, and I'll demonstrate all of this in just a second, and expected move, and kind of narrow down the search, because as you know, there's a million things out there to trade. So how do you trade them? Well, Edge Raider gives you the edge, and I'm here to tell you, I've been trading since 1973. I actually had a Russian immigrant. He was a Jewish immigrant who was a money manager, and he taught me to trade, and I have been trading ever since. And I started with a year's worth of my profit sharing from Sears, because I worked at Sears at the time, and I had not quite $3,000, and I put it into an account with him, and he was at Sherson Lehman. That was before Sherson was acquired by American Express and merged with Lehman and all the rest of them over the years. But here is basically what I do, and I'm going to take you through these screenshots, and you can see I sent this to Chris also. Entry was possible on 1018, and you could have bought an 11. That's on AMD. Those went from $5 to I think $20 or something like that, even more, before I pulled out. Now I'm going to go over to the EdgeRater software, and I'm going to take you through my process. And for those of you who don't know what EdgeRater is, it is a very, very powerful Excel spreadsheet program that takes on data every day for the stocks that you want to trade. And I generally, about once a month, download all the data for all the stocks, but I focus mostly on the CBOE weekly stocks. And there's plenty to trade in here. All the good guys, all the bad guys, and you can look at them for longs and for shorts. This one, this actually is something that Chris developed for me at my request. And what it does is it allows me to change the moving averages. In this case, it's a 2 and 20, so I can see what's going on. The default is 8 and 20. And that's what I traded for years, because I was taught that 9 and 21, when I was trading commodities, was the best crossover averages. And I always teased George Lee, and many of you knew George Lee, but I always told George Lee that I like the 8 and 20 better because I can get in before he does. And I always got a giggle out of that from George, because he was a better trader than I. He was very, very good at what he did, but he traded all day long every day. And I'm not going to do that anymore. I did that for many years, but I spent most of my focus when I was trading all day long every day, trading the S&P futures contract and the OEX options. Well, the OEX options are out of fashion now, but I still trade them from time to time, and I use them for hedging my portfolios. And my portfolios have gone from the humble $3,000 that I once had to many, many, many times that. And this is how I use them. The first thing I look at is the moving average crossover with upcoming probability. And you can see the moving average cross was up today. The number of bars showed it was 1 bar since it went up. And if I double click on Yum, I can actually get a graph, and I'll shrink this up just a little bit. I usually like to look out 2 months, so that gives me plenty of real estate for a graph. Okay. But you can see the crossovers right here. You could have taken a trade on Yum 5 bars ago, and it would have sold off 2 days ago. Now, I was looking at now to take a trade back last month, and I didn't do it because I was heavily invested in Tesla. This is Intel, and frankly, I'll show you why in just a minute. Intel doesn't excite me because it doesn't have a lot of movement in it anymore. And as you can see over here, I'm going to show you a little trick here that Chris taught me. I can highlight this row, and it will tell me that I have, this will default to 10 years or whatever the available data is in your database. And you can see the most in the next 2 months that it should do is 5%, 70% of the time. And 70% of the time is my desire for statistical probability of a trade going in my direction. So if I'm doing, and you have to understand options, and you have to understand statistical probability, and you also have to understand standard deviation. So I know that this particular stock is going to move 5% over the next 2 months. So I can take a short-term position, or I can take a long-term position. But if I take a 2-week position, I've only got a 60% chance to make 2%. In a month, that gives me 2%. It's trading at $50, and 2% of $50 is only $1. So that's something that I'm not interested in. But if I want to know what the options traders think Intel's going to do, let's go over here and look. And we'll go to expected move for the next 30 days. And Intel has got an IV, implied volatility of 28%. Sorry, I'm a little tongue-tied. With an IV rank of 29, and that's fine. But they're only looking for a $4 move up to $54.81. It could also go lower to $46. Well, I want, and there is the graph. Each one of these templates, as they're called, defaults to a different graph. Now, I want to show you something really, really incredible. And this is where I like to graze. Okay. I will go to the next stock down, which is Amazon. And you can see that the expected move for Amazon is 299 points. So if you have, we'll go look at statistical probability in a minute. If you have the potential for going 300 points on Amazon in the next 30 days, and you're betting with the crowd, is that a trade you want to take, or is Intel you want to trade for $4? Well, you got to go look and see how expensive that option is and what you can afford. Okay, we'll talk about that in just a little bit. Look at CME. CME is right there in the middle. Okay, when I say in the middle, it's only a $240 stock, $225 stock, and it's got a potential of going 18 points. Let's go look at seasonality. On CME, you've got a potential of going 3%, 6 out of 10 years, or 9%, 8 out of 10 years over the next 3 months. I'm interested in CME. And because I have watched tens of thousands of graphs and stocks, charts, as it were, for 40 years. Look at this down here. Volatility came way down through here. And then right here, it peaked and it came off. And when volatility comes off like that, there's 2 things you can do. You can sell volatility, which means you can sell above the market. But because we have a potential of it going up 9%, 8 out of 10 times, statistical probability is 80%. I'm going to bet with the crowd. Okay. And so I'm looking for that 18 points that's in the expected move. Understand how options trade. If I go look it up right now, I can tell you that that option is going to be not too expensive, but I can still trade a normal 10 lot without looking at it. So if I can trade and get a 50 delta, which is at the money, that means that for every point the stock goes up in the beginning, I'm going to get a 50% return on the option. So if I'm looking for it to go 18 points, my minimum game plan goal would be 9 points. Okay. 9 points on 10 contracts will give you $9,000. And that's how you have to think. So now let's go over here and let's look at the same stock. And we're going to look at the squeeze. Oh, and it's not showing up here. Let me go back to CME. I'll go to, it is not now in a squeeze. So let me do a Control F and go see if I can find CME. And what that does,
yeah, Dave, the reason it wouldn't appear on this screen is because there's a filter on there under the squeeze column, which is only showing the stocks that are currently in a squeeze. So if it's not in a squeeze, that one won't show up there, but you can turn that filter off from that squeeze column. If you click on the little drop down there you go.
Yeah.
Yeah, and then say clear filter. That's the one, yeah. Now you've got everything. Now, if you go back to the other report, click on CME again. That's it. Click on that row.
Okay. So I recognized it as being in a squeeze. And here is the chart for a squeeze, but it didn't quite get into a squeeze. And what a squeeze is when the Bollinger Bands hide inside the Keltner channel. And that was one of the very first trading techniques that I was taught. Go look for commodities that are inside the Keltner channel, turn on the Bollinger Band and see if it qualifies for a squeeze trade. Because a squeeze is like loading a shotgun shell. You're packing it with powder and packing it with powder and packing it with powder. And that at some point, it's going to explode. And when it does, it's going to explode to the upside. Okay. So I'm going to go back over here to continue on. And I'm going to go back up to the top. This is the moving average with upcoming probability. And what I generally try and do is I try and use the drop downs to only show me 100%, the 90%, and the 70%. So in here, for the next 2 months, up trades, and I'm focusing on up trades right now because the market seasonally is in an uptrend. It's having a tough time bouncing around and chopping around. So everything that I do from mid-October until now is going to be seasonally a long trade. Now, that's not to say that there isn't an awful lot of short trades to take in here, and I can make money a lot faster going short than I can long. But let's take a look at some of these and just see what they have to offer. Okay, and look at Google. Okay, and I'll look at Google's expected move. And let me talk about each of these columns too. Right now, it is above the moving average crossover, okay, that I look for, but the slope is descending, okay, or decelerating, okay. If I went to AZO, it's doing the same thing. Now look at CMG. CMG is decelerating, but or accelerating, but is it accelerating in the right direction for me? Not right now. Mealy. This has been a tough week for some of the big techs. Now, Align Tech is one of my favorites to trade. Let's go over here and look at expected move on Align Tech. Yes, 68 points or 10%. And seasonally, we're looking for 10%, funny thing, 7 out of 10 years on Align Tech. Okay. Netflix, bearish, reversing candle, but you've also got a wick hanging out the bottom, which means that there's a lot of indecision going on here in Netflix. Adobe. And understand too, everyone, I have not pre-screened any of these. I walked in here this morning about the same time you did. I think I got on the Zoom with Chris about 15 minutes before 11 my time, which is 9 broadcast time. So here's what I'm looking at. 8 out of 10 times, 5% on Adobe. Options expected move is 65 points. So if I wanted to trade 65 points, that would give me, if I was buying an option, a 50% delta would give me 30 points. 30 points would give me roughly $30,000. Okay. Now, just for grins, let's go over here and see what we could do with that. Here's Tesla, and I'll come back to Tesla in a couple of minutes because I want to show you another potential trade. Okay, these are all the ones I'm tracking now, and I'll leave you alone to write these things down, and just know that the last one on this screen is Microsoft, and I'm going to replace Adobe with it. Okay, that's a nice pickup right there from the 20 moving average at 645 to 688. There's 40 points. Okay, so now if I go over here to trade and I do Adobe, and because I'm going out, we can do December or January, but let's look at the cost of the December, and it's currently trading at 688. So I'd probably buy a 680, and that might be a little expensive for some people. But so let's go up here to let's go to 700. Okay, 700 is going to cost you $18.85 a share ask, so $16 by $18.85, and that's pretty widespread, but that's after expiration. And here's what I'll do. I'll do a single, and I'll buy. I'm gonna lower this down to 2 because that's probably what I would do. So
Dave,
confirm and send.
Dave, we can't see the full screen. We can only see the put side on here. You've probably got that over several screens in your setup, but
Can
going
you
through
see? can you see the order confirmation dialog?
Yeah, I can see that. Yeah.
Okay. Well, this is what I chose. Okay. What I'll do is I'm gonna delete that. I will take this. Sorry, gang. I'm accustomed to working on.
Oh yeah, that's good.
No, that's all right. I'm accustomed to working on multiple screens, and I could have gone to the other computer to show this too, but here we go. We're currently in December, and you can see the break for at the money. This is the call side, and this is the put side. And up here, we have, this is an expected move as calculated by Thinkorswim. So it's saying 38% or 57 points. Okay. So I'm going to say you can actually go down here to a $10 strike at 725. Now, for me, I want to be closer to the money. I probably want to be a 40 delta or a 50 delta, and this one is a 44. Okay, so I will enter an order for that, and I'll buy a single. I'm not going to buy okay, there we go. I changed it to 2. Confirm and send. So this is the confirmation. A break-even point on the stock price is $718.85. Max profit is infinite. Although remember, you're limited by your expiration date. Max profit is $3,700. And your buying power effect is $3,700. So if you wanted to make let's say a $10,000 bet, you could actually go up to those 10, confirm and send, and that'll be an $18,000 potential profit. Your buying power would be 18,550 in margin. So if you wanted to trade this and keep your trade around $10,000, as I was taught in the beginning, then you would have to go with 5 contracts. Okay, but that's the kind of thing that you could look to achieve. Okay, now let's go look for another one. Write down Adobe and go back and look at the parameters on it. So let's go over here. Netflix. It's above and it's accelerating. 7 out of 10 and 9 out of 10. There's 35% on Netflix. Okay. So let's go to expected move. Netflix, we're looking at 60 points. Okay. Expected move. All right. This was run earlier in the week, I guess. The close was 687. So if you wanted to look at other parameters, you could also look at down here to, let's go to this one. All right. And this is what I look at. I have my own template created, and on Netflix, it shows the expected move, and it's supposed to have the cone on it too. So let me go look over here and see if I can find the cone. Just got the bands.
Yeah, the reason you can't see the cone, Dave, is you don't have enough space showing. So if you expand the chart up a little bit by dragging dragging that slider over to the left.
Yeah.
That's it. And now you get the opportunity at the top to add where that 0 is, you can add more bars, and then the cone will appear. There you go.
I'm going to put 60 on here, so it'll take it further out. Now, what I'll do too is I'll squeeze all of these down. I'll explain them all in just a second. Now, for those of you going, oh, this is all Greek to me, it will become second nature. Okay, and I'm telling you that the things that you will learn along the way will show you how powerful the software can be. You can see out here at the end of the probability cone that it can go down to 659.72, and it can go up to 725.25. Well, options traders are betting that it's going to go 63 points higher. That will keep it within the one standard deviation, which is what a typical stock will move. And if you watch your entry, you would probably be able to pick up the option at a lower price too, because I can see down here in the short term, the IV, the options volatility, has been dropping from here. It was at 32, and over here it's at 31. So that's not much of a move, but it is dropping. Now, something else to be cognizant of is it can go to 628. Okay. Now, how about Monster Beverages? Monster Beverages, and its volatility is rising, when the moving average cross happens again, we'll go over here and look at Monster Beverages. We've got an 80% chance of a 5% move. Okay, and the expected move would be 9 points, 8.5 points. So 50% move there would be $4.50 on a 10 lot purchase. That'd be $4,500. Just remember, 10 lots will make $1,000 per lot. Skyworks, another one of my favorites. All of these, in fact. 9% potential for 15 points. These come down out of the stratosphere in pricing because the price of the stocks is much lower. Okay, but we're looking at 7% with a 7% move with an 80% probability seasonally. Okay, and let's see what else we've got here. I want to go back up.
Dave, do you have if you scroll to the right of those reports, do you have one that you ran for 11? What was Friday? Was that 18 or 19? 19? 11, yeah, 11, 19. Yeah. And it's probably because you keep the program open and you like to run it and keep those reports open. You've probably got a later one.
Yes.
Yeah.
Here's something that I want to show too. That's okay. Here's the current in play, and that was run today. and RSI power zones. Here's the weekly signals, options, IV, and rank. And I know there's a lot of people that don't like to trade an IV rank less than 20 because sometimes it can be in the doldrums. I have found sometimes that there's a lot of opportunities there too. So I'll go back here to seasonality monthly and I'll show you all the templates that I like to use. And then I'll turn it back over to Chris and let him take you through the ones that he's developed and what he finds most important. Okay. And every trader has got his own cup of tea, so to speak. But if I look at December, which is coming up, here is, this is Blackstone Group, and it's always a big mover when people are moving money around. Marvell Comics, it's currently outside the expected move. And so what I might do is watch it closely to see if it came into a pullback. And here's CMG, Twilio, Mankind, another one that I trade all the time is Microsoft. Okay, that one's going to be expensive because the IV is high. But look, it goes 3%, 8 out of 10 years. The expected move, 3% on a $300 stock is going to be $18. Okay, let's go back to expected move. Seasonality now, we're looking at 8%. I got to go. Expected move, there we go. Yeah, $23. So just think of the different stocks with their statistical probability at 70% or better. They will generally stay within one standard deviation, which is a band 68% up 34% and down 34%. And then your expected move is just basically the market that the options traders see where prices are going. So my basic starting point is seasonality, and I go look at the moving cross, which is in this case a 2 and 20, into statistical probability. 70% over 2 months is 3% for Microsoft. AutoZone has fallen apart the last few days because there's a rotation going on from that which worked to that which didn't. But it will also be back. And you can go down here and you can look at all of these different stocks and what they're doing. And you're not going to see anything different on these charts than you see in any other charting program. What you are going to see is all the statistics and those statistics that matter. Okay, so the first thing is let's just use Microsoft, and there's the short-term crossover, and what it's going to do 80% of the time over the next 3 months, 70% of the time in the next 3 months, and look at the change from here to here. This is a time to take advantage. 70% of the time in the next month, which means the next 30 days, you're going to get a 2% move. That's $6 in Microsoft. And then you could get $9 in 3 months or in 2 months. And then you can get 24 points in 3 months. And remember, every point at 50% is $1,000. Here's the expected move. I live and die by this one. Okay, this is the expected move that the options traders say it's going to happen, 23 points. And if you want to find out what all the big boys are doing, sort this column from greatest to least. So Amazon's expected to go 324. Tesla's expected to go 251 points. Shopify, 243 points. Okay. Now I'm going to show you one last thing on Tesla, and I'll turn it back over to Chris, and I'll jump in if I need to. I'm going to go to charts, and let's put Tesla here. Now, I just came off of a big move in Tesla from October 18th, I think it was, until we got in here. And I closed that trade out. So it was a biggie, to say the least. Okay. But look at this. From here to here was another 50 points. Okay. And this is the 5-minute chart, and this is the 30-minute chart. And I've got everything all squeezed down now, so you can't really see them. Let me take this, and I'll do my okay. And I just got interrupted for a moment. Sorry about that. I have 2 grandsons playing in tournaments in Las Vegas, and one team won 21-8, and 20. The other one, that 2 games was 21-8 and 21-2, and then the second team was 13-1 and 11-2. So both my grandsons are doing great in Little League Baseball today. Thank you very much for cheering them on. Okay, so here you go. I actually bought the 1100 Tesla, okay, and it's trading at 1137. So if you just did a quick calculation on that, the 1100 to 1137 is 37 points. So how much is that on a 50 delta on 10 contracts? Think about that. And there is opportunities to be had all the time. Chris, I will stop sharing and turn it back to you. If you have questions.
Maybe just a couple. Yeah, there are a couple of questions. I don't know if you can see the chat, but I could read the questions for you. There's just a couple that you might want to address. So Ralph asks, what kind of money management strategy do you use once you place the trade?
A 50% stop. If something goes wrong and I misread it, I close the trade, and walk away to trade another day. And I will give the market 50% of what I invested. Generally speaking, I can tell long before that. But let me give you an example of something that I do every Monday. Every Monday, I buy an S&P spread, whether it's a call spread or a put spread. And over the last couple of years, it's been almost exclusively put spreads. Okay. And what I do is I sell a 19 delta and I buy a 14 delta. And I put in a stop, and at 50%, generally speaking, what I look for is a $2,000 profit. So I put a stop at $1,000 and walk away. And if that trade doesn't work out, I lose. Actually, it's a $10,000 investment, so I can lose up to $5,000. But I also that's my target profit is $2,000. The on the put spreads, that's a 19 and a 14. On the call spreads, generally I do a 16 delta, which is one standard deviation, and I do 4 strikes away from it. So let's say it's trading at 4,500. I'll sell the 16 delta and buy. It's about the same, about 12 to 14, and I'll put a stop in and walk away. But once the trades work in my direction, I never look at it because I put in a buyback order, and I do that every Monday, 21 to 45 days out, because I get enough juice in there to give me a couple of grand profit every week. And I think in the last, I just sent all the stuff to my tax man. In the last year, I probably lost $6,000 with that strategy. And, you just take the number of weeks that I've done a trade like that. And the reason I trade the S&P like that every week is because I'm taxed differently. 60% long-term capital gains and 40% short-term capital gains. And then I throw all these other things in there that screw up my tax man, because I wind up with a giant gain on something like a Tesla. And now I'm going to have another probably 25,000 on top of that. That gets treated differently. That's all short-term capital gains.
Nice. Then there's another question. Do you ever trade it as a call spread? I think that was on SPX, but yes. Do you ever trade those Tesla trades and the Nvidias and those kinds of things as call spreads?
They can bite you in the butt, especially when you're talking about, I understand wanting to lower your cost, but you really don't know where that silly thing's going to go. So if you want to limit your risk, buy a put spread. Find your. Oh, I'm not sharing my screen, am I?
Yeah, you are.
Oh, I still am. Okay. Well, right here was. Let's see. That was 1021. I actually bought an 880, I think. On 1021, what you could have done at that point was by a 1 standard deviation, excuse me, out of the money put. If you sell that one down here and buy it 2 to 4 strikes below it, you would make that profit and have a very good chance of never having to look back. But it's very dangerous to sell call spreads unless you go way, way out. And I want statistical probability on my side. So if Tesla's going to go up 250 points in the next 30 days, and that 30 days happens to be from this past Friday, or it could go down to 930. I would want to make sure that I'm selling below that 930 and buying a protected put ahead of it. Okay, and the same thing with if you were to do a call, then a call spread, then do it way up there at this says 252 points. Do it up there at 1400 and buy a 1420. How much profit that would give you, I don't know, but that's in my game. My batting average says doing it my way works, and buying calls is not necessarily the general rule that people like to go by. But if you're going to do that, you can make really good money by focusing on. Let's go over here to IV. That's expected move. Where's my IV? No, I can't find it, but it'll just take me a minute.
Must have been back further.
Must have been, yeah, but let me get, there we go. This will just take a second. See how quick this thing is? And it'll pop this report up too. Okay, so what I would look for here is, let's see if we can find CME. All right, CME has got an IV of 25, and it's currently in a, come on, dang it. Mouse is cooperating. It has an IV rank of 77. So that would be fine for me. So what I would do is I would go over here to expected move. Let's do seasonality now first and see over the next 2 months, it's going to move. Well, look at this, 9%. Okay. So I will go to expected move on CME is 17 points. Okay. And it's a reasonably priced stock. So if you wanted to do a call spread, I would do a long 60 and a short 40 maybe. Let's go look at that here. CME is what we're working on, huh?
Yeah.
And we'll go over here to come on, trade. That gives me CME and December. Yeah, these are dirt cheap. Okay, here we go. CME's come off a bit, so the IV's up here a little bit. let's go, I'm having trouble focusing. My eyes are out of focus. Okay, we can do, all right, let's sell that and buy, let's go, I go here. Okay. Oops. And sell this. It's buying the 195. And let's do that. I want to do this the opposite way. Sorry. So we will. And I could have taken vertical, but I think it limits my choices. Okay. Dang it.
I think you just hit the X by it, which gave you the trade grid above instead of hitting the number.
Yeah.
That's all that happened there, I think.
Okay. Well, this is embarrassing as hell. Okay. I'm going to sell.
Okay. Yeah, single.
Vertical.
Oh, vertical.
Okay. So that gives me a 210, 200 for $920 credit. Okay.
Mm-hmm. That's 10 wide, so the risk on that is 9,000 then, I guess. Yeah, there you go.
Yeah, exactly. You follow that?
Just quite a big risk for, the maximum profit you can get from that would be 1,000, is that right?
Yeah, maximum profit would be
920.
$920.
Yeah.
Or a $10,000 risk. So it's a 10-to-1, and you could shorten that up by just doing a sell a vertical and let them tell you what you're going to do. That's 10 wide.
Yeah.
Let me do it.
205 maybe.
Yeah. Oh, it's not offered. That's why.
Mm-hmm.
Yeah, the 205's not. So I could do a. Let's see if a 207 is offered. Not traded. No. Okay. So I honestly on this one, let's go look at the chart again. Yeah, there you go. That's CME and I put my stop at 220.
Mm-hmm.
And I'd put it just below that at probably 219.50, and I go ahead and sell the 220.
Okay.
Yeah, sell the 220. All right, and sell 220 vertical, and that should give me a 220, 210. Okay, and that'll cost me. It'll give me 2,400. There you go. There's your 3-to-1. Max loss is 7,600. How's that?
Yeah, that seems
Yeah.
better. You're a bit closer then to the to the actual price. So
Yeah.
but that's how it's giving you more of a credit.
And if you do it on expiration Friday, like this past Friday was, you could pick up on the theta for the weekend, and everybody's moving around positions and they may not be paying attention. And CMG could be one of those that they'll try and rotate into for, and that's, there you go again, that's the guessing game. But this is, that's why I like, this is CME. This is the guessing game. It could go all the way down here to 216. And but you're looking for a 240 rather than you're looking for a 240 price, which will get you way away from that 220.
Yeah.
Okay. Now, for me, expected move and seasonality of 3 months. Absolutely. I'll take it. Thank you for the trade.
Now, do you ever, because you're looking at a 3-month seasonality, but your trade isn't over 3 months. Your trade is, what kind of time frame do you use for the trades? Like a month?
21 to 45 days. And that's generally, that's what I did with Tesla.
Yeah.
I actually went out 2 months. And so if I was to do this trade, it'd be a lot juicier if I went, I want to delete this. And if I went to, let's see here, I would go out to, I'd go to the 40 days. I wouldn't go out to the January expiration. But let's do, let's see what we got here. Let's go to 20, sell vertical, and that'll give me a 220, 215, and buying power is actually a little bit less, and the loss is a little bit less, and the credit is at $2,000. That's a nicer trade because you're spending more time.
Yeah.
So you got a lot more time for that trade to develop.
But if you had something, so this is an interesting one. Then if you went out that little bit further, so you've got a bit more security in the because you've got less at risk, would you change your stop? So would you let it sort of go a little bit beyond the 220? What would you do there?
I would put my stop at, oops, let me cancel all of these. So the answer is yes. I'd probably drop that stop down to 216. What's that's 222 down here. Move CME. Here we go. Yeah. 221. Yeah, I'd probably drop it down in here. This is currently at 209. Yeah, I'd probably run it up to 215 or 216. And give it some room to move, because there's a lot of see, the volatility is 25%.
Yeah.
And the IV rank is currently 57 there.
Would you set the stop in so that it would hit intraday, or do you just keep a kind of an eye on it and do it
No,
manually?
I'd actually put a hard stop because, and this is where I put it. I picked this number down here, these tails, and that's 218, 219. Because what I like to do is do what I call a walkaway trade, where I know no matter what happens, I'm out.
Mm-hmm.
Okay. The first is the stop, and then the next is the profit. Okay.
Mm-hmm.
And I'll always try and take 50% profit over my expected or my expectation. So on this one here, let's say CME is supposed to go 17 points. I'll take 8 points out of it. And for me, that'll give me 8,000.
Mm-hmm.
But at that point, I got nothing to worry about, right? I can go to my little garage workshop, and the time that I've spent this morning, just over an hour, is about all the time I need to spend. And the market for me opens at 8:30, and I'm generally breakfast, out of the shower, and gone someplace by 10 o'clock. And sometimes that's for a shingle shot. Sometimes it's to the market with my wife. Sometimes it's out to my little garage workshop. I have a wood shop that I go putz in for a couple hours every day, or out to lunch with friends.
Mm-hmm.
And this week I'll be working on cabinet doors.
Well, I think you mentioned to me last weekend that really, if you do it right, you're just going to make 3 or 4 trades in October, and you're done for the year.
Well, yeah, because I look for what's in the squeeze, and because that's the launching pad. So let's go up here. Okay, this one's in a squeeze. This is real estate, and you can see how dramatically it's in a squeeze. Not generally one that I would look to trade. Expected move is 6 points. Okay. So what I do is I bring this up, and you can see the length of the squeeze is 12, 6, 28 days. And I'll just flip on down through this, just like this. And what I'm looking at is, I would never trade BlackBerry again. I have in the past. Becton Dixon is a good trade because it's in the medical industries. Comcast, I'm not a big fan, but if it makes sense, then this is how I look for trades. Chevron. Okay, I did Chevron way back here. I did Chevron when it came out of the squeeze here. Okay. That was September 20th. Okay. Now, I can't share the exact trade with you, but I was looking for it to go. I was looking for it to go up because, and I'll tell you very honestly why. I trade ExxonMobil Limited, Phillips, PSX, COP, Conoco, CVX, Valero, MUR. I trade all of those all the time. Sometimes I own options. Sometimes I own back ratio spreads. I still own a back ratio spread in Apple, and Apple's been inactive, but it hasn't made any money or lost any money, because if you do a back ratio spread correctly, it will. Let me take a minute here, because this is a good. Let me go over here to File, Open Page. Yes, I want to trade all that, and let me go see if I've got in this one. I'm sorry to deviate here.
It's fine. Yeah, I'm sure everyone's happy to hear whatever you want to talk about.
Save pictures. No, not that one. I am looking for, oh, it's going to be in this one. It should be coming up. There we go. Okay. What is, oh, this is TQQ. Ah, glad I did this. Hey, gang, watch this. Whenever September rolls around, I wish you could see me on camera. My hair is standing up on the back of my neck. Whenever September rolls around, you asked about a longer term trade. Well, this was on October 21st. I was watching TQQ. Now, if you want trades that work all the time, this triple beta Q stock is a really good one. And I got to be honest with you, I put it in all of my long-term portfolios. I'm talking about portfolios that go back to 2008, 9, because when I can buy it and cheap, it goes up 3 times. And if you do it like this one happens to be a 140 call from October
21st.
October 21st, and it went from, let's call it $10. What did I buy it for? I bought it for $9.50. There we go. I put it on the screen, and then it went all the way up here, and I pulled out, and this is where standard deviation comes in. This went all the way up to $30. And I thought, you know, that's too far away from the 8 moving average. You'll notice that this is the 20. Okay, so just like the Bollinger Bands, and I wish I could add these after the fact. This is a picture, but it went from $9.50 to $30. Okay, and that was in a month. Okay, so now let me go up here to this one and see if I've got, well, let's see what SPX has got. Now the data runs out on these things. That's the problem. And I'm going to have to save this one as a picture before the end of the day, because it'll clean out. No, Apple isn't in here, but I had a picture of the Apple back ratio spread. And while I'm here, let's go construct one. Have we got time for it, Chris?
Absolutely. And actually, there was also a question, so this will help answer it. Somebody was asking, Ed was asking what deltas you use for back ratio spreads.
Oh, that's real easy. I do a 70 delta and a 50 delta. I buy 2 of the 70s and I sell 1 of the 50s. and I look for option skew, and I'm also looking for 90 to 100 delta, theta. Okay, so I'm getting an offset by selling that 50 in the theta. Okay. What are the delta? Okay, that's it. So let's go make one. First things first, let's go to Apple. And for me, this is December 17th. I will go, and I'm going to tell you, I'm going to hunt for a trade for me. Okay. So I won't do it today, but okay. So here we have a 75 delta on 150, and it's currently trading at 60. All right, well, let's just yeah, let's just put that. I'm going to edit this, and I'm going to make that a well, first of all, I got to go out to I'm going to go out to January. Okay, make sure I get and I'll sell this one. Okay, because that'll give me my 50 delta. Let's see here. And I'm going to add an option leg, and I'm going to do a buy to 150s. Okay. And we'll do this to start with. Okay. Chart the spread. Okay. Okay. Now, this is a little more difficult chart to read, but here's my probability cones. Okay. This is 2 standard deviations. This is 1. So I'm going to go edit the cones, and I'm going to take off 2 standard deviations. Okay. And that'll show you what I can go to. Okay. I'm going to take that one off too. Remove that guy. Okay. So the white line is actually the price of the option. And you can see it's already gone through the roof. But also down here, here's your volatility comparison between the puts and the calls. And you see volatility has risen tremendously in Apple. So you know that Apple has really moved, and you can see that here. Okay. So you following me?
Mm-hmm. Yeah.
Okay. You got to watch the notes there, because I'm not paying attention to the chat room.
Yeah,
Okay.
that's fine. I'm looking.
So our if I'd have found this or thought about this earlier, I probably would have done this already. Okay, but there's the chart of just the options. Now, what I want to do is I want to do a risk graph. I'm going to edit this, and I'm going to do fill prices. Come on, there we go. I'm going to do fill prices. This is just a play screen. Okay, so the 160 call is 680, and the 150 is 1330. Okay,
Mhm.
just for grins. Okay. And I want to chart the spread. No, I want a risk graph. That's what I want. There we go. Okay, and this is what it's going to look like. I'll drag it in closer. Okay, so your risk is taken out because I'm only showing 1 for 2. This is a $2,000 risk, and one standard deviation will give you $3,500 profit. Okay. And that $3,500 profit will be at 194. So let's go back over here to expected move, and Control V gives me APL. Boom. Expected move gives me 13 points up to 173. Okay. In the next 30 days. Okay. So that means it's going to go from 142. Oh, that's actually,
Yeah, that's October.
whoops. Yeah. Where are we? Here we go. Okay. So here we are. What was I doing in October? I think I took that one off it back in here. Okay. So here we go. This is this past Friday, and we're still looking at another 13 points to go. So we're going to go 60. And what is my my current price is 160, so it can go to 173, which is right in here. Okay. And that's one standard deviation right there, which takes us to 176. And that would be a $2,700 profit. Now, I also believe that now that this thing is on the move, we're going to see the volatility expand, and it could drive it out into here. Okay. And I believe if I tell one of my other secrets, it would be to move the, let me just put it in here. I will add a study, and I can't do it on this chart. I got to go to Apple Daily. Now let's put on add a study, Keltner channels, and I'm going to change this to my secret weapon at 3 standard deviations on the Keltner channel. I should be gone. Okay, I'm going to turn the Bollinger Bands off. Oh, let me show you that right now. Okay, here is these two. Sorry, it can get a little confusing. The two outside bands, and I've changed them to, on other charts, to be gray. These two are Keltners. When Bollinger Bands contract inside the Keltners, that's when you're in a squeeze. Okay.
Yeah.
So you go from a squeeze here, as soon as it breaks above the 20, which is this blue one, the blue mid band, that is your trade. And that happened on 10/14. So you can take your first position there and go, whoa. It went out to the end of the squeeze, and Bollinger Bands hit the Keltner channel, pulled back to the 20. You can add a position there. Doesn't matter what stock it is. If it fits these criteria, it goes back up, back to the 20, and here we go. It was loading up with that gunpowder that I talked to you about earlier. And this is where it went from 149 to 160 in 4 days. Okay.
Mhm.
We go back over here to, you'll see exactly the same thing. Here it is. It's in a squeeze. It comes down. I don't have a 20 moving average on this. It comes down just outside the Bollingers, and it pops. Bada bing, bada boom. Okay. And that option, let's just call it a 150. Okay.
Mhm.
Let's go here to, I've got a little window, option chain Apple and 150. Okay. I'll chart this option here and take off all of this stuff. Edit study. No, I want to remove study. This one. Probability cones. Okay. So right here, it was at $6.11. So you got a double.
Mhm.
Okay. $13.49. And that's on the January.
That's on a single option, right?
One single option.
Mhm.
Okay. Now, if I was to do the risk graph now, risk graph, Apple, here we go. Okay. And I was to go a 150. Let's just change this to, there's the 150 at $6.20. Okay. And we sold the 160 at, let's call it 450. I can go back and look, but let's just call it 4.50. Okay. So now you've changed your risk from $750. If you'd have taken the trade at the proper time, you would have risked this $750, $900 at the most. Yeah, $800. And today you would be $1,190 in the money. Now that's using ratio spread of 2 to 1.
Mhm.
Now, look, what if you had gone? Let's sell 5 and let's buy 10. Okay.
Mhm.
So now you $6,000. Is that livable? And what you have is an option position, which duplicates a long stock, and your theta. Oh, I forgot to look at it. Your theta is still going to be around 100. Okay, if I change these back to so 1 by 2. Okay, and your theta is you're at about 80% right there.
Yeah.
Okay, well, that's 3. Fat fingered that one. There you go. Your delta is at 97, so you're getting 97% of the stocks move, and and your theta, your decay is 3%, just under 4%.
Mhm.
Okay. Does that make sense?
Yeah, yeah.
And did I answer your question on the back ratio spread?
I think you did. Yeah.
Great
Saying so.
idea. Thanks. Okay. So now you can take this to a different level. I did a study for my own retirement portfolio, and I actually spun off a chunk. And I'll be honest with you, after 3 months, I didn't want to do it anymore because it kept me thinking about it all the time, all the ups and downs and everything else. With all my stock positions, I just kind of ignore them, and they do what they're going to do. And I think I've said this before. The way I've positioned my portfolios, they're well diversified, and they pay me not to think about them, because every month I have dividends coming, and stupid ones like ExxonMobil has gone nowhere, but it still pays me 6%. Chevron pays me 5.5%. That's not a lot of money to make on a portfolio when you're young. When you're young, you need to do this. So in this case, you're spending $790, $800, and you're up $400. So you've made a 50% return since you entered the trade roughly a month ago. Okay, that is a great return. So for me to go back and reconstruct my portfolios is an expensive proposition, because I'd have to take off some positions so I wouldn't be overweight, and put on new ones that I would have to tend in the garden. But for someone who is young and has the initiative and the time to weed his garden every month, it would be terrific. But one of the things you're going to miss out on too is Apple doesn't pay a great dividend, but in this case, it doesn't need to pay a dividend if you're getting a 50% return in less than 2 months. So you take that times 6, that's a 300% return in a year. So that was my thinking when I decided to spin off a portion of my portfolio and do it just in back ratio spreads, because you're not you're not losing time value. And that's the big disadvantage to options. You've got to trade them like I did the Tesla trade.
Yeah.
And when you trade the Tesla trade, that's a huge return. And I'm not looking for home runs all the time. I'll take a couple $1,000 a week on 10 contracts. Sometimes in September, I'll start doing 20, but I want you all to have what I have. And if I could just open my brain and spill it out into the screen, you would see what I see. And what I see is a trade like this, a trade like the Apple, just a long call trade, and the Tesla long call trade. And in the beginning, that that Tesla long call trade was 10 contracts.
Mm-hmm.
And that was a lot of money.
Well, yeah, 10 contracts on the Tesla trade would have been about 14,000, right? But I believe,
yeah, it cost $14.50 plus commissions.
yeah.
So let's call it $15 a trade, $15.
But the percentage return was incredible for that trade, wasn't it? Even though you didn't, because you as you said, you sold some on the way up, but you
Yes.
still had a very good return.
Yes, but there was still a truckload. Okay.
Mm-hmm.
Most small company owners would love to have made that much money a year. I'm sorry to see James Meyer go. Thank you for coming. Thank everybody for coming.
Yeah.
Learning.
Well, yeah, thank you for spending the time and going. I mean, we only planned to go for an hour, and it's now been an hour and 40 minutes. So really appreciate your time for sure.
Oh, I see Wojak's online too. The best to you too, and to your bride. And so Keltner is set at 3 standard deviations for, no, the Keltner is set at 2. The profit target is set at 3. I'm sorry I wasn't clear on that. The standard Keltner channel setting is 2 standard deviations. And then I look at one of my profit targets, it's 3 standard deviations. Is that more clear?
Do you have any regular sessions anywhere, Dave?
Do I have any what?
Somebody is asking. John is asking if you do any regular sessions. Sessions of education.
No, I don't. But that doesn't mean it can't change. Perhaps what I can do is work with you and develop a routine, or show the routine that I do. Mm-hmm. But and I don't need to show this screen. I can just show, that I go from here, which is moving average cross with probability, and then expected move, squeeze, and I can use either squeeze. I can use George's or mine. I like George's because he's got a custom sort in it. And then I like seasonality now because that gives me normal stuff, and then seasonality monthly. And I generally will follow it up with a couple of others like RSI zones and then stocks that are in play. Mm-hmm. And because this is so powerful, I don't have to download data every day, but I can go back here to let's go backwards at the top and see what I got in here. I had closed the program and reopened it for this session, I think. So all of those are gone unless I went to the reports section. But I really like these. Let's go back over here. These are my main ones. Moving average cross with upcoming expected move, daily squeeze, seasonality now, seasonality by the month, options IV and rank, weekly squeeze, monthly squeeze, RSI power zones, which is Larry Connors. I got to see Larry Connors in Seal Beach at I think it was Spaghetti Factory one time in the early 80s, I think, and he introduced the RSI power zones. That was really cool. And I bought a book from him. I think it was Buy the Fair, Sell the Greed, and then there was another one. In Play is one that you introduced me to.
Yep.
And then weekly and daily MACD. There's somebody out there on the internet teaching how to do your daily and weekly MACDs, and it works. It's not my favorite, but it does show what you're doing, what you're working on, and let me click on this one. Oh, where's my MACD? There it is. Yep. You get a double bottom with a MACD crossover. So you got a MACD crossover, crossover the moving averages. It goes up, it comes back down, and your MACD still holds. This is a good place to start. So it's very worth looking at, especially when you start looking at a gazillion different charts. Here's one that went on the MACD cross, went from 215 to 235. That's 20 points. So there's so many useful tools. Thank you very much for developing all of this, Chris. It is a wonderful, wonderful tool. I wouldn't trade without it. And I recommend anybody this has put me light years ahead of everybody else, because I have this tool integrated into my trading routine. And I don't have to go searching the planet for who's doing what to who, because it's all right here.
That's great.
Yep. So I'll send it all back to you. I'll stop my share.
Okay. Yeah. Thank you. Thanks a lot. Thank you so much, Dave. That is amazing. And I mean, of course, I'd be very interested in working with you to, for, produce information for people. If we wanted to try and hone down on an exact routine to follow or something like that. We could do some more sessions, or if people were interested, I think that would be cool if you were up to it, of course.
Yes.
But I think this has been great, and that's going to take probably quite some time to digest and review. Look at the recording. Yeah, there was one thing that I was going to show quickly before we left. Because it had been brought to my attention. So if I can share my screen, let me try that.
It's all yours.
Okay, let's see if this is going to work. Sharing my screen. Am I sharing my screen? Yep. And that is, yes.
Yeah, wait till you see this new one, guys.
Well, you had mentioned to me the NVIDIA trade, right? And
yes,
you were looking for, I think you were looking down here to get involved, and then but then you were also looking for a pullback around here. So I'm not sure if you managed to get that, but as we were talking last weekend, that did play out quite nicely. But yeah, so one thing I could show quickly on here is this is something that I'm working on. It's not quite available yet, but this chart that you see over on the left-hand side is a chart of how the various options have performed over a certain time frame. And the way that you work this is you say, for instance, we're looking at NVIDIA here. You can draw a line on the chart and say, how did the options perform from this bar through to, say, this bar here? And if everything was working properly, this would go out to grab the data. I'm not sure it's going to work right now. And you could tell if it was working right now because the call side of this would be showing major gains. But for some reason, that is not working. Anyway, this is all in development. The idea is you draw a line on the screen, and this chart would update to show performance. I might be able to get this to work if I just clicked on this. Hang on 1 second. And try again. Okay, there we go. Yep. So, yeah, so between these two dates, which would be October the 14th and November the 4th, this is basically this data here, which are the percentage changes in various days to expiration and various deltas. So taking deltas from the negative 0.9 all the way down to essentially on the negative side, so these are the puts, and then all the way up to from 0.1 to 0.9, and then charting it. So in a case like this, and this is quite an interesting chart over that time frame, this is showing that this blue line, which is your 22 days to expiration, the 0.1 delta 22 days to expiration had a 7,500% gain. So that's 75 times what it was initially bought for. And so very quickly you can see how those options changed in price. Anyway, this is something that will go hand in hand with looking at the expected move and trying to get a feel for how implied volatility can affect the potential return in any option. For instance, the date that this option was purchased in this scenario, the implied volatility, looking down at the IB30 number here, was quite low, 0.37. And in fact, if we look at, so 0.37, we can see that the rank of that is down here, which is the 10th percentile of implied volatility. So quite a low implied volatility, with price moving as extremely as it did, led to this massive gain. However, that wouldn't be the same if you were purchasing when implied volatility is so high up here, instead of it being down at this 37% implied volatility, on this green bar here, implied volatility is already up to 58%. And if you take the red bar after that, it goes up to 65%. And so potential gains in an option are going to be significantly reduced because you're having to pay so much. But this tool will help show those kinds of relationships, which I think will be very, very powerful. We could take, let's just do a little example here. So go back to Tesla. And let's see the move that we were just talking about with Dave just a minute ago. We were looking at the October around 21st, I think, was when you initially made that trade.
Yes.
So around here. So if we try and see from the 21st up to this bar up here, there again, you've got on the 0.1 delta, you've got with 15 days to expiration. So it's a very short time frame, but potentially there's a 70x gain in there. But if you go down to some of these more stable deltas, whereas a 0.1 delta is quite likely to lose 100% of the investment, whereas a 0.5, you're obviously not going to make as much in a 0.5, but you still get to make, in this case, 10 times, so it's 1,000% gain. But of course, it's not as much as here. But then again, you wouldn't want to be investing $14,000 in a 0.1 delta, because there's quite a good chance you can lose the whole amount. But anyway, this kind of, I think this chart will be super powerful, but it's so much data to put online to enable it to work in the program. To give you an idea, to put this data online is will take about 1.5 terabytes worth of drive space somewhere in the cloud, and a fairly beefy machine to actually analyze the data and give back those numbers. So I'm working on that, and hopefully that will be something that will come in the near future. And then one other thing I wanted to say is a couple of people have said already, watch out for the Hindenburg omen. I don't know if anyone pays attention to the Hindenburg, but it is something that Ian Woodward used to talk about quite a lot. I know that Jeff Scott looks at the Hindenburg a lot. And the Hindenburg omen has a claim to fame of that there's never been a market crash without the appearance of a Hindenburg omen. However, you can get Hindenburg omens without the market crashing, but they don't appear that often. So when they do appear, it's time to sit up and pay attention. And we always run the Hindenburg report on the list of Hindenburg stocks. And if we run that right now, and I probably have already run it, let's just have a look in here. Do I see Hindenburg? Oh, I have to run it. So let me just do that. And the reason I wanted to see if I had the report already is I know this takes a little bit longer to run. But I can tell you that for the last 2 trading days, the Hindenburg omen has fired a signal. So that is worth paying attention to. When it's finished processing this, we can see exactly the conditions that cause that to occur. It's nearly ready. Okay, Hindenburg omen. So right here, the last 2 trading days, we have got all 4 conditions that make up the Hindenburg omen are true, including the elusive new highs less than or equal to 2 times new lows. Often you'll get 3 of these, and you won't get that 3rd one, although in this case you did, but you didn't get new highs and new lows are greater than 2.2%. So there's a bunch of conditions that are required to make a Hindenburg omen. The last time we actually had a Hindenburg omen, so we go scrolling all the way back through here, you see there hasn't been one for a while. So let's see when the last one was. Okay, here in February the 21st, 2020, if I go over to my SPY and click on SPY, and then make sure I'm highlighting the dates. The last Hindenburg omen was right here. All right, and we have now seen 2, one day after the next, appearing. And I'll squeeze this chart down so you can get this in context. So we've now seen 2 in these 2 bars, and there hasn't been one in the subsequent period. So, I know the market is just continuing to go up without stopping. You often think that it's going to sell back again when you get moves like this in here and this in here, but these have all happened without Hindenburgs. So anyway, just something to pay attention to. But also, it's no guarantee that the market's going to sell off. You do get these appearing during rallies as well. So, but anyway, just thought people should know about that. And the Hindenburg symbol list, Ed, it should be in your list of symbols. If you click on, just look in the drop down, there should be a Hindenburg.txt. If you don't see that, I'll check to make sure that's being delivered when you do your data update, because it should be. I will check on that.
We got it.
Okay. I think, yeah. So I think I think with that we can probably close this down. Appreciate everybody spending some time here this morning, and especially appreciate Dave with the presentation. That was really interesting. So thank you very much, Dave. And
you're all welcome.
We hope to hear from you again as soon as we can put some other information together. So thanks a lot, everybody, and see you all soon.